panel discussion next. Our first panelist is Sunil Singhania. He's the founder of Abacus Asset Management Company.
Next, we have Hiren. He has over 25 years of capital market experience. As director and CEO of Alchemy Capital, he is also responsible for managing and advising assets over $1 billion.
Our next panelist is Rajeev Radhakrishnan. He currently heads the fixed income desk at the AMC.
And to moderate the session, we have Fatima Karan. We'd like to welcome back. She is the consulting editor at Bloomberg TV India, and she anchors the newsroom, Final Word, and together with Bloomberg Women Mean Business.
Thank you.
Sorry, that was a mistake.
It's fine.
BTVI,
Business
not
Television
Bloomberg.
India, but that's
Sorry,
fine, no problem.
our mistake. Take it home, ma'am.
Thank you. Ladies and gentlemen, thank you so much for being a part of this conversation. I'm not quite sure if everyone can hear me very clearly here, but I hope so. Not sure about how many of you here were in the earlier session. I hope you're not fed up of me just yet, but we still have another half an hour to go. This is a great opportunity I have with this panel because we're actually going to be talking about the state of the economy as well as whether this is a good time to be an entrepreneur and how easy is it going to be or difficult it's going to be given the kind of environment that we are in. It's a rolling discussion. We are limited to about 25 minutes, but it's a great opportunity for me. The first question I'm going to ask all my panelists, and you can, of course, answer as you wish, is how bad are things at the moment with the economy? And I'm going to start with you.
I think if all of us forgot what a business cycle was, then that's what we are experiencing today. We are, obviously, it's all in the papers, has been there for a while that we're clearly experiencing a slowdown in the economy today. Whether it is rural demand, whether it is urban demand, there are some sectors, particularly in the economy, which are currently challenged, real estate being one of them, automotive being another. And as we all know that, a significant part of that slowdown has been caused because the credit cycle in the economy has got impacted, right? So we, because of certain events that happened, which started with the IL&FS crisis and then it moved on to other players in the real estate and the housing finance sector, we do have a situation right now, and this is not the first time it has happened, that, for probably the short to medium term, we believe that, the flow of credit and the debt markets are actually challenged, and until this get resolved in a significant manner, probably we have to live with the side effects of that, and that's one reason why we are seeing a slowdown in the economy. And my sense is that we are probably closer to the end than when we are, but it's been a tough time the last few months.
Sunil, I want you to come in right immediately because Sunil is an optimist and he also talks about, he likes to also, I would like for you to also talk about this whole idea of scare and fear that sometimes has set into the conversation. How relevant is it and how worried should people be?
Right. So I think we have a mixed audience here. We have some really young professionals and some experienced professionals. My experience over the last 20-25 years of working in India has been that we have the cyclical challenges which keep on coming up, and those challenges shake our belief in the country, shake our belief in our own ventures, in our own future, but it has paid off to be optimistic. So over the last 20-25 years, whoever has been optimistic has basically ended up doing much better than those who have not been. And actually, if you see from an equity market perspective, I'm an out-and-out equity investor. Over the last 20 years, we have had so many challenges. You know, in 97, we had sanctions against India after the Pokhran thing. We had 2000, the dot-com boom and bust. We had scams that time. Worst financial recession, economic recession in the world from 2001 to 2003. We had left parties in the government. We had 1 in 200-year kind of event, which was Lehman Brothers. And then multiple such events which kept on sort of shaking our confidence. But those who have been optimistic have reaped the benefit. And I would say that this time, yes, the scare, I would say, is very high. The length of the slowdown, I would say, is also a little bit longer than normal. But we are also seeing transformative, sort of steps which have been taken. So at some point of time, you had to shake the PSU bank mentality of obliging while giving loans, or not having proper risk parameters. We have the IBC in place now. So obviously the initial phase of cleaning the kachra is always painful. And maybe in the next 3 months, maybe in the next 6 months, but the way our structure is, the way our economy is, the way we have so many young professionals, there is no doubt that we are heading to the $6-7 trillion over the next 10, 12 years.
So it's all quite manageable, so to speak, in a sense.
No, everything is manageable. The will to manage should be
The
there.
will to manage. Okay, that actually, that's a good one, actually. Rajeev, I want to talk a little bit about the debt markets at the moment. Transmission has been an area of concern. Separately, we've also talked about this cleanup and the kind of resolution process that seems to be dominating the headlines. I just want to make this a little simpler. Say I'm an entrepreneur, or I'm a person who is trying to build a business over the next few years. What is it that I should really be looking at, and what are realistic expectations given the situation when it comes to credit going forward?
So very clearly, credit markets in India are dislocated at this point in time. You have had these issues in the financial sector with a couple of entities defaulting, and then significant rating notch downgrades in a lot of other entities. So unfortunately, we are in a situation where a prolonged period of, you've allowed a long period of liquidity crisis to sort of be prolonged, and eventually you will have solvency issues. And I think that's the single biggest risk which we face in the credit markets, because an issue has, it's been there for more than a year now. And unfortunately, we really don't have any clear visibility on a resolution to this. And my take on that is it's not going to be isolated to a particular sector. So when you're looking at cross-sector linkages, I think that's something that is very, very, at this point, underappreciated. Okay. Because you're not really seeing a situation where if this issue is not really resolved, it's not that it gets isolated in the financial sector. You have already seen significant slowdown in different sectors of the economy, and I believe it has an impact in terms of cross-sector linkages. Now, for someone who is actually looking to raise capital, debt capital especially in such an uncertain environment, the challenge is very clearly, one, access to capital. Second, even if you have access, what is the cost? Because today, we've seen credit spreads being fairly elevated. You have, over the last few years, we did worry about lack of transmission of policy rate cuts. But incrementally, some part of transmission has happened because liquidity has started to improve. But where has the transmission happened? Purely on the sovereign. Government of India has been able to borrow at much cheaper rates. Yep. AAA public sector entities or few private AAA credits are able to borrow at slightly lower rates. But a large segment of the market, which is not necessarily AAA, but they are not necessarily, I would say that's the space where incrementally you will see a lot more of action, and a lot more of entities would be in that space in terms of their rating. And if capital is starved, the debt capital especially is not really available for this segment, I think it has a material impact in terms of how you see a sustainable growth in the markets.
Okay, all right. Just moving this conversation a little bit in terms of opportunity when it comes to both entrepreneurs, business stakeholders, as well as those who are sort of looking at how they're going to really make some money going forward. There have been sectoral bets, so to speak, that have fizzled out, in a sense. One of the tougher jobs of investment managers is to look at the voids that exist and how they can perhaps be filled faster than others. Hiren, what would you say to me if I said, look, what are the next sort of sectors one should be looking at, given the fact that we've seen factors such as, a slowdown in rural demand, in autos, in some of the other sectors that have had a lot of difficulty? Where else can we look at growth going forward?
See, actually, in a country like India, where broadly incomes are rising, and if we are talking about a $5 or a $7 trillion economy, there is a significant headroom for growth in virtually every sector. I think what's interesting about the current time frame or what we are experiencing is that there is a great opportunity for two kinds of businesses. One, we are seeing that in every sector I'm seeing there is massive consolidation happening, right? So there are a lot of players which are being forced out of business because of whatever reason. I mean, either they don't have access to capital or they were previously too leveraged. They have not been able to adapt to new technologies, and there is competition that is coming from new ways of doing business. And that is creating a space for new entrants and new companies to come in.
Okay.
Right? So for a lot of entrepreneurs here, I mean, when business is normal and the cycle is expanding and everybody in the existing players are growing, I mean, one way to participate is that because there is growth. But what happens when growth is slowing down and we are going through a phase like this where there is consolidation in every sector, is that it enables new players to come in, right? The more efficient guys to come in. From a purely investment perspective, I think that for us, we believe that this fear psychosis sometimes gives opportunities for you to, because there is mispricing that happens when there is fear.
Yes.
Right? And this mispricing is where we see an opportunity to pick up assets. I think it's a great time, for example, currently for private equity funds and distressed funds and venture funds to pick up assets at 50 cents, 30 cents, 40 cents to the dollar. So whether I'm a private equity investor, whether I'm a public listed investor, or if I'm a corporate with a strong balance sheet, I have the ability, because of the bankruptcy code, today I'm being offered assets which are much cheaper for me to buy rather than to build something. Okay. So I think every crisis also brings opportunity, whether you're an entrepreneur or an investor. I think it's a very, very interesting time at this point in time.
Sunil, would you like to come in on this opportunity that we have at the moment?
So actually, if you go back to our history, we got our independence in 1947, and the initial phase of our fathers and forefathers was to ensure that the family got roti, kapda and makan. It was only in the 80s that the first lot of educated Indians came up. They set the first stage of industrial revolution. They made more money, and then they were able to send their kids to IIT, IIM, even abroad. I think the current generation of the professionals which are coming up are much more educated. They have seen the world. They know what is happening globally. No one wants to go abroad, or very few people want to go abroad. In fact, my friends from abroad want to come to India. And I think that is going to change the whole dynamics of how India works. So if we don't get a headwind from the government, we don't want a tailwind. We just don't want a headwind from the government. I think there is enough entrepreneurship which will be more, I would say, cutting edge technology rather than just being the back office of the work.
Okay.
And that is going to drive the next phase of super growth as far as India is concerned. When I have a son who is, just finished his undergrad in computer science and is going his master's. When I ask him what he wants to do, He says, I'll set up my own enterprise. That confidence comes from two things. One, he has traveled the world. He has looked at his colleagues and all. Second is he doesn't have to struggle for roti kapda aur makan because he's past that stage. So the ability to take risk in the current set of young budding entrepreneurs is very, very different. And I think
threshold is different.
That is going to drive the nation. As I said, we just don't want headwinds. If there are no tailwinds, it's fine. Just don't put headwinds in front of us. That's it.
Rajeev, because we talked a little bit earlier in terms of the debt markets and the technical side of things, the question I have from sort of non-finance people, so to speak, is how much of what we're seeing when it comes to challenges in the economy can one actually attribute to some of the so-called landmark reforms that were announced by the government. Demonetization, of course, was extensively discussed. GST implementation was another thing. But here, I want you to sort of take your thinking cap away as a credit guy and tell me what you think about that question, which is how much do you really blame or you sort of say is the government's role in where we are with the economy?
How I would say that it's been clearly a missed opportunity. You mentioned about Demon, you mentioned about GST. Some of that could have been done better, but again, that's in the past.
It's in the past.
We are fortunately in a cycle where, on a relative basis, India is still attractive when you compare with most EMs or some of the other markets as well. So there are opportunities which are available. When you consider the current context. So if you are a debt investor, a global debt investor, you are in a situation where almost 13 or 14 trillion dollar worth of sovereign securities globally are trading in negative territory. So there is very clearly an yield spread that one can gain if you are an investor in Indian debt, and broadly even the credit markets. But is money coming in? The answer is no. And why is it not coming in? Because you've still got a lot more of restrictions on accessing the Indian debt markets if you are an offshore investor. So these are some of the, I would say, of course, we do need to be calibrated in the way we open up debt markets, but I think if you delay that opening, I think that's an opportunity that is getting missed because there is a pool of capital that is willing to take the risk, which is willing to invest in India, but are we creating hurdles or are we not smoothing the process for some of these funds to come in? And I think, again, very relevant to what's happening in the markets these days. So we have had, as I mentioned earlier, a few defaults, downgrades, but there are distressed funds, which are all global funds, which are picking up assets at 35 to 40 cents on the dollar. So there is that money which is willing to take the risk, which may, to some extent, address some of the dislocations that we have. So that's one thing which probably policymakers could address.
Okay.
And secondly, on the economy, have we really done that second generation reforms? The simple answer is no.
Okay.
And the more we delay it, especially when cyclically we are in a position where you can probably absorb or attract some of the capital that is floating around. So if you miss that, I think it's like, you're just sort of missing the bus in terms of getting that capital flows into the country.
I just want to ask something as somebody who's sitting in Delhi, and of course, this is after the budget came out, and the way we were looking at it, of course, we are a business channel and we're very focused on policy and the economy, but there is, of course, politics that comes into a lot of how we look at things as well. What was said in Mumbai about the budget? Were there expectations? Was there some kind of feeling that perhaps the expectations were a little high given where we were, or was it something that was the announcements that came out perhaps not compatible with the kind of expectations investors and the wealth creating community had? And I'm going to start with Hiren, who has the misfortune of sitting right next to me.
He's trying to duck. He's trying to duck and he's looking at me.
Yeah.
I thought I could pass that on to him.
It's a fair question.
See, I think, what happens is that we tend to focus on fires that are burning currently.
Right.
And one of the most important fires that all the economic players think is burning is that do something about growth, get growth going in this economy. And everybody was looking at the budget to say that You know, it's okay if we relax the fiscal deficit a little bit, but you know, do something to pump up growth, or give some significant tax incentive or you know, benefits. So there are a lot of things that people wish out of a budget, right? I think the central this thing was that what will the government do to take us out of the current slowdown and the morass that we are seeing, or the stress that we are seeing in the system. And I think that, you know, I think the message from the budget that I took away was that, look, I mean, we're not going to bust the fisc to pump prim the economy, right? We're not going to give an artificial injection to bring growth. Unfortunately, after 2008-9, we saw the global financial crisis. I think everybody has gotten into this mood that anytime there is something that happens, the central bank or the government comes in, intervenes, you know, pump prims the economy and gets growth going. We are so used to these booster shots. And I think the thinking of this government, the way I read it, is that, look, I'm going to clean up the system. I'm going to bring structural reforms that formalize and make ease of doing business better. Now, this may cause pain in the short run. A lot of the structural reforms that this government has done are temporarily growth dilutive, but in the long run are significantly growth enhancing.
Okay.
Right? And I think the thinking is that let's take the pain, let's not do something which is unsustainable, because in the past we've seen that whenever we've tried to artificially prop up growth, you do get a booster growth, but then you see the after effects of that. And we are currently seeing the after effects of unbridled credit growth that we saw in the previous cycle, and we continue to see the deleveraging cycle, right? So I think, to my mind, they have done a few good things. I think there is a lot of focus to get foreign direct investments. There is a focus to monetize government assets and recycle that money back into public spending. And there is a certain amount of focus that has been given to low-cost housing, because they did give a significant tax break over there. And as you heard Mr. Gadkari, that they really want to encourage electric vehicles, renewable energy. These are areas of focus that the government wants to focus on. So I think, and I agree to to a large extent to Sunil. What he said was that I think what people want is, don't put headwinds. Just let us do our business. And there is enough initiative that we have on our own that we can get things going. So I think it will take a little bit of a while, and obviously the surcharge was a little bit of a, left a bad taste in the in the investors in the market. But I guess these are things that people come to terms with very quickly, and I think if some of these issues are resolved, I think we should get growth going very quickly.
Sunil, anything you want to add to that? The question about really this whole message that has come out, which is we're going to take some pain at the moment, and we're not going to go for the easy way out of things. As a government, that's clearly what came out. We've also seen some stern messaging that has also come out later for investors. What was your key takeaway when it came to the budget, as well as perhaps the announcements that we consistently keep getting?
So, I think I agree that some of this has been because of the past excesses, and those excesses have to be undone. The only one thing is that, when the economy is going through a pain which we are witnessing now, you have to maybe do some things a little gradually, or you can defer it. So this surcharge on so-called super rich, when globally every economy is trying to cut taxes and make it more efficient, we went the other way around.
Yeah.
It's going to impact only 6,000 people. So politically, it's fair, You are making 1.3 crore people happy and maybe 6,000 people not so happy. But what the signal it sends to the global world is that are we heading into a scenario where government doesn't have the money and they're trying to squeeze out every bit, which in fact is a little bit retrograde. The other thing is that, yes, we need to clean out the system, but we should not be creating scare. So I think to some extent, there is, can you call it scare or milder word, uncertainty in the minds of entrepreneurs who have the money, but they don't want to invest. So when I go to investors seeking money for our funds, everyone is sitting on cash. They are investing in FDs at 6.5%, paying tax and getting 4% net. But the scare is so much that no one wants to either invest their own business or even invest in equity. If you look at the balance sheets of companies, yes, the growth has been a challenge. The top line growth has not been there, but the balance sheets are so efficient.
Yeah.
Debt is so low. The costs are so well managed compared to what we had seen during the Lehman crisis. The problem is crisis of confidence. So all we need is a little bit of push that, get going. We can live with a little bit of slowing down as far as tightening of the system is concerned, and we will be there. And I think we should get there. So the good thing is that now people are very active on social media.
That can be good and bad, by the way.
I don't know. I am an optimistic, so I always look at the good parts. They are commenting on what they feel without any hesitation, without any fear, which is what democracy is all about. And hopefully we will start to see a little bit of action on that front. As far as our demographics are concerned, 20% of all human beings born in the world after 1st January 2000 are Indians. 20%. I own a beer company. I like it because 20% of the of those born after 1st January 2000 have still not come to the drinking age, and they're all Indians.
That's something to look forward
to. And that is going to be true for all the segments and all the products and all the services. So we have a long, long way to go. So I think these are, I would say, an opportunity. So as an investor, I'm frankly very happy that I'm getting an opportunity to buy something at 50% of what I would have bought it 2 years back.
Okay, just 1 second. While we talk about this demographic dividend, which is a term that has been used amply, there's of course also been that entire fear about how it could perhaps go the other way if we do not manage our education as well as job creation correctly. How do you look at that, Rajeev?
So if you don't do that, it could be a demographic curse as well, because it's an opportunity, but one needs to
But are you sensing any danger given what we're seeing with the so-called demographic dividend versus disaster, and given the kind of stats we have when it comes to job creation as well as education? What are your thoughts on that?
So I think very important job creation is something that is absolutely probably not really been up to the pace that is required considering the stage of our economic cycle. So there has to be adequate focus on that. Entrepreneurship, yes, one needs to encourage that. And so there are challenges. So end of the day, when you have a very a positive demographic opportunity, one should not really miss out on that, because you need enabling policies that sort of enable you to take advantage of that. And I think that remains a big challenge for the next few years.
Okay. Anything you'd like to sort of talk about with
I think it's a little bit of unfair to expect that the government will do everything.
That's what I was going to get into, which is what are the realistic expectations here?
I mean, it's not the Prime Minister's job to create jobs.
Yeah.
The government's job is to create an enabling environment and policy for businesses to flourish. And entrepreneurs and businesses will create their own jobs, right? I mean, I think, also I think this whole notion about, losing out jobs because of AI, robotics, machine learning, automation, there is this scare that has come about, that. And I think that partly the answer is in terms of reskilling.
Yeah.
But I think that there is enough and more, supply over time creates its own demand. Like I remember when we were studying, and because the capital markets and finance jobs were paying very well, I mean, everybody wanted to send their sons to become an MBA or a CA or whatever, right? Then it came to software engineers. Now, you know, so every 8 to 10 years, there is a demand for a certain kind of skill sets.
Okay.
And, you know, over a time, I mean, it's not a switch, but over time, skill sets, supply will come up and meet that demand, right? I think a little bit too much has been made. I think where we need to be really creative is that, look, everybody is not going to become a robotics or a scientist or a data scientist. I think we need gym trainers, we need, you know, swimming coaches, we need chefs, we need, you know, people who are in art, in services. I think we need to think a little more creative about creating jobs. I mean, we should stop thinking, I mean, manufacturing is just 18% of GDP, right? Services is a very large part. And there is a large spectrum of opportunities that we can, you know, where jobs can be created. So we sometimes look at this in a very narrow sense of the word. And we land everything onto the doorstep of the government to say that, what are you doing to create jobs?
Okay. That's a great point, because I'm going to ask you my closing question, because we are out of time. Let's reverse this whole question. What is it that the private sector, do you think, really needs to hear at this stage, given the kind of offtake that we're looking for?
So one is, I think credit has become a little bit difficult to get, and it is very expensive. I'll give you a short, thing. You know, I met a large solar EPC company.
Yeah.
And they said that to set up a solar plant in India, 1 megawatt costs 3.5 crore rupees. In Abu Dhabi, it costs 5 crore rupees. Because, you know, India, it's cheaper to get people and engineers and all. But in Abu Dhabi, solar power sells at 1 rupee 75 paisa a unit. In India, it sells 3 rupees a unit, despite the capital cost being low.
Yeah.
Because in Abu Dhabi, interest cost is 0. In India, the interest cost is 10 to 12%. So if you have an interest cost which is like so high, large facilities are not going to come into India. Similarly, I met a fab seller in Bangalore. They only sell, they don't manufacture. And I asked him the same question. He says to raise $3 billion in India will be so expensive, it will be completely non-competitive. So I think one is liquidity has to be available, which has been an issue last 2-3 years. And the other thing is transmission of credit is very necessary. So RBI has cut 75 basis point, maybe they will cut another 25 basis point, but housing loans from 8.5% instead of falling to 7.5 have become 9.5%. So technically your houses have become 15% more expensive. So that is the other thing. And the most important thing is the government has to give comfort about labor reforms. Our garment units hire 2,000 people. In China, in one unit, you have 20,000
But
people.
land and labor are two of the most controversial topics. When are we going to
But we have to do it if we want to get to 10 trillion and $20 trillion of economy size. Otherwise, we should be happy with the $2 trillion economy.
Anything you'd like to say, Rajeev, about
So I
this?
think, so more than cost of finance, availability of finance to a large section of the large subsectors of the economy, I think that's a big challenge today. So that dislocations in credit market, I think one needs to sort it out at the earliest. The budget did announce a proposal, but unfortunately, even now we don't have the details. So they need to tweak that further, roll it out fast, and directly address the issue. So that's something that I, as an investor in the debt market, would really want addressed.
I just want to thank all my panelists. Firstly, thank you. I hope the audience enjoyed that conversation. I've had to abruptly end it because I've been told that the audience is dying to ask a couple of questions, and I know you have to leave in 5 minutes. So I'm just going to take these questions very quickly, and then I will release my panelists as promised. Once again, thank you so much for this conversation, and to the audience. Okay, we've actually talked about most of these, but let me just specifically ask one of them, which is, how big is the impact of the ILFS issue on NBFCs? And how can we anticipate this affecting SMEs? So anyone who wants to take that very quickly.
I think it's, I did remark on this in
Yeah.
the opening remarks. So this is something which is spread beyond IRNFS.
Yeah.
SMEs, I think we are already seeing signs of stress. There are, if you look at the Mudra loans, which is specifically targeted at SME, there are reports that incrementally the NPAs there are getting, it's just going up. So why that is happening? Because to a large extent, SMEs did depend on NBFCs for their funding. Banks are not necessarily in that particular space. Today, the NBFCs don't have access to money. They have cut down disbursements substantially, and that definitely impacts SME borrowers. So that's the contagion effect which I mentioned earlier, and which unfortunately is still an issue for the credit market. So I think we need to see some resolution at the earliest.
At the earliest. I'm going to just ask a specific question here on wealth creation. This is just ask it right out. What is the only and possibly the best opportunity we have for wealth creation in the next sectoral? I think the person's trying to ask, where do we go? How do I make the money? And please tell me before you tell anyone else.
So I think if you want a wealth creation, first be positive on India.
Yeah.
Because unless you're optimistic and positive, you'll never invest. Second is don't get into this sector and this talk and all. I think have a diversified portfolio. The economy is growing at 6-7% hopefully. I think you will be in a position to easily generate a 12-13% CAGR over the next 15-20 years. And at 12% you double your money in 6 years, at 14% you double your money in 5 years. So it starts to compound. So I think don't get into this sectorial thing, because sectors will have their years of being in and out of fashion. But if you have a diversified portfolio in a good mutual fund or any good instrument, will always consistently generate wealth.
Last question for my panelists. Is India as fiscally fit as it is sometimes projected to be? The CAG has said that the fiscal deficit is an understatement of the actual situation. Not sure which of my panelists wants to go on this, but quickly, if I could get an opinion.
So India is as relevant as it...
No,
We're talking about the fiscal health.
I frankly, I'm not an economist, but I don't understand economists. So in US, the interest rates 6 months back were 3.25%. And the economists said that if we touch 4%, we will be doomed. And then the interest rates became 2%. And now they are saying that because the interest rates are 2%, we are doomed. So, in US, post-Lehman, fiscal deficit touched 10%. Because that was a need of the hour. So in fact, I would have been happy in the budget if instead of 3.3, they would have increased the fiscal deficit to 3.6%, but not imposed this additional taxes which they did.
Sure.
So I think from time to time, we'll have to adjust that.
Can I just say just leave the fiscal deficit to the economists.
Yeah.
You just focus on the opportunity to make money, you will be fine.
All right, on that wonderful note, just want to thank my panelists here, Sunil, Hiren, Rajeev. Pleasure speaking to all of you. Thank you, and thank you for the audience for those questions as well as listening to us. Thanks for that.
Thank you. Thank you.
Mike, please. Yeah, we would like to request you to stay on stage, please.
Sorry?
Please stay on stage. We would like to invite few people to felicitate the award. So I'd like to invite Mr. Prashant Biari, Mr. Vivek Kaul, and Ms. Renuka on stage to felicitate the awards.